Hey, I'm Ben from Modern Graham, and today we are going to talk about AFLAC Inc. So be sure to stick around to hear what I think of this company. So today we have AFLAC. The ticker is AFL. The current price is 70.13. The sector is financial services, and of course, the industry is insurance. Looking at the balance sheet, we have the figures that are most important from the balance sheet in my valuation methods. We have the total current assets, the total current liabilities, the long-term debt, the total assets, the intangible assets, the total liabilities, and the shares outstanding. All of these figures will come into play in the valuation. Over here, we have our chart showing the earnings per share and the dividends per share, two of the most important numbers when looking at a company. You can see in blue that the earnings have really steadily risen over the last 30 years. You love to see that in a company. The same thing with the dividends. They have gone up and up and up. Looking at the detail in the earnings, you can see that, sure enough, they have gone up almost every year. That diluted figure. Here, we have the earnings per share Modern Graham, which is a weighted average, looking at the last 5 years of earnings, putting the most weight on the current year and the least weight 5 years ago. And that helps to smooth out the business cycle and give you an idea of the trends in the earnings. And what is significant about that is if you look at this, every single year that has gone up. That is very rare in a company. You don't see that very often. It is a very good thing to see. Dividends. Let's take a look at those. Dividends per share is this column here, and dividend growth is this column. And you can see the dividend has grown every single year. It was growing at a huge pace up until the financial crisis, at which point they slowed the dividend growth, but they've continued to grow it every year, which is also a rare thing to see and very encouraging. The dividend yield, interestingly, it was very low compared to what it is now up until the financial crisis, and then that has come up. The dividend payout ratio has been higher now than it was before, and that is also interesting. Stage 1 in the Modern Graham analysis is to determine if the company is suitable for the defensive investor or the enterprising investor. And remember, the defensive investor is somebody who is not willing to go to extensive research. So they have very difficult tests that they put every company through and have high standards for a company. So first, we have the market cap has to be over $2 billion. Of course, it passes that with $43.6 billion in market cap. Current ratio has to be over 2. It passes that easily. Positive earnings per share for 10 years. It passes that. Dividend, it pays that, passes that. And increase in earnings over the last 10 years. It surpasses that requirement. PEMG, it is below 20, so we've got a positive there. And the PB ratio has to be under 2.5. Here it is 1.81, so we pass in that regard too. And if you've been keeping count, we are up to 7, a perfect score for the defensive investor. The enterprising investor is somebody who is willing to do extensive research, but because the company is already suitable for the defensive investor, it is by default suitable for the enterprising investor. Be sure to take a moment real quick to like the video, subscribe to my channel, and when the video is over, click in the description below or a pinned comment down below. There is a link to a free valuation calculator that you will find useful in your research as well. Stage 2 is determining the actual intrinsic value. Remember, the value of a company is different from the price the market is currently paying. And so we have to determine the intrinsic value to decide if the company is worth a long-term investment. And to do that, we take the formula that Benjamin Graham taught in his book, The Intelligent Investor. And that is value equals earnings per share times 8.5 plus 2 times the growth rate. I've updated it to use my weighted average earnings per share to help smooth that value out further. So we have two variables we need to calculate. We have the earnings per share, which again is a 5-year weighted average, and that comes to 630 SIPs currently. And then we have the growth rate. And for the growth, we take the current earnings per share and that from 5 years ago to get a total growth of 57.27%. We divide that by 5 and we get an average annual growth of 11.45%. Now we put in a safety margin because growth is a key variable in this formula. It is easy, if you overestimate your growth, to have a huge impact on that value output. And so it's important to have a safety margin here to keep your value conservative. And so we get a growth estimate of 8.59%. Plugging those into the formula, we get a value of $163.33, which, of course, the current price is $70, so that shows that it is undervalued. And this handy chart here shows all the information you need. We've got the current price up to here and the value way up to here, so it is undervalued. A few other important things that are useful with the formula. The value based on a 3% growth is 92.22. That value on a 0% growth would be 54.06. Now, if you put price in for value and then solve for growth, you get a market implied growth rate of 1.26%. Now, that would be something that you'd look at and say, okay, well, I think the company will grow more than that in perpetuity, so therefore the company is undervalued by the market. Or if that growth rate that the market is implying is higher than what you think, it could indicate that a company is overvalued. So that's another way of thinking about this formula to, like, you can calculate the growth rate that the market is implying, and then you can figure out if a company is over or undervalued based on that. Looking at the score for this company, we get 2 points for an investor's suitability of the defensive investor. We get 1 point for being undervalued. It gets 1 point for trading below its Graham number, which we'll talk about in a moment. It gets 1 point for a long-term dividend growth. It gets half a point for a dividend yield above 2%, and half a point for being below its industry average PEMG, for a total score of 6 points, which is an A+ grade. Stage 3 is to do further research. So if you've decided that the company is suitable for your specific investor type, and we've decided that it's undervalued, then the next step is to look at other things and decide if it would be a good fit for your individual portfolio, taking into consideration your own investing goals and your diversification in your portfolio and other things like that. These are some things that might be useful. Net current asset value formula, that doesn't apply here. That would be a floor because that gives you a liquidation value. And here it is negative, so it isn't really helpful in this particular situation. The Graham number formula, this is taken from it's been derived from the defensive investor requirements and turned into a formula and then a number called the Graham number. And a lot of people use that as an easy way to quickly determine the value. And here the Graham number is 80.50, which is above the price, which would be another indicator that it might be undervalued. The PEMG formula, again, that's the price to earnings formula using the weighted average, and that is 11.03. Current ratio here is 17.14. PB ratio is 1.81. The dividend yield is 2.28%, and there are 33 years of consecutive dividend growth. Moving on to stage 4 in the analysis. We're looking at the chart now, and we do that because not because we're trying to figure out the value based on the chart. No, the value has to come from the financial statements. But we look at the chart at this stage in the analysis because if you've decided that this is one that you want to look into investing and adding to your portfolio, the next thing to do is to try to maximize your profit. And you do that by analyzing where the market is taking things. And it can be useful because sometimes you can see that the market might be pulling back a little bit and you might have a better entry point. So looking at the chart here, you can see this is the daily view, and it has been going up and up and up. And in fact, if you go back to the weekly view, you can see that that rise has been going on since September. And so 3 months of steady growth here, and then it has pulled back down. Now, these green lines are support and resistance lines that have developed. Here we have one that is about here, because that is where we had a turnaround there. We had a little bit of a turnaround there, and I think that's it for that one. This one, we had a turnaround there, and it hit it here again and then fell back down. Then up here, it had trouble getting through that this week in the week of Halloween. And then the next week, it was above it, but it came down and tested that. So these are key support and resistance levels, and a new one has developed up here where the high was. Looking at the daily view, what that means is two things. One, while it is underneath this resistance level, it may come up here and then it will come back down. And we are seeing a new potential, like a smaller resistance level developing here, or support level. If it continues to fall, it might come all the way back down to here. If it breaks above this level, then it will be moving up higher. And that's what I would anticipate. So pay attention to that as it moves in this area. The other thing to pay attention to here is the RSI, the Relative Strength Index. And there's a couple things to note about that here. One, it is a little bit high. This shows the momentum. And the momentum went up, and then it has come back down. And you can see that in the chart, that it slowed here. And now the momentum, as indicated by the RSI, has come back down to about a medium momentum. And you can see the trend by looking at this red line is the moving average, and the blue line is a longer moving average. So again, the trend in momentum was rising, and now the trend in momentum is coming back down. So it is losing the momentum, and it might be coming back down here. The other thing that's important to note is that up here, this red dashed line is 70 RSI, and breaking above that indicates that the company is in a bullish pattern. If it breaks below 30, then it would indicate that the company is in a bearish pattern. And you can see that, yeah, it broke above here, and previously it had been down here in a bearish pattern, and it was flat. Then up here, it managed to break above that, and it entered a bullish pattern. So it came back down a little bit, but it came here, and when it got close to the 30 RSI, it started to turn around, and that was where you really started to see the rise that it has had as it gained more and more momentum and showed very bullish tendencies. Now we are still in a bullish spot, and I'd be watching this to see, like, if it does start to fall very quickly, I would see if this comes down and if it crosses over 30. And if it does, then it would indicate that it might be entering a bearish pattern again. But if it doesn't and it starts to come back up, then that might indicate a good time to enter. So those are the things to look for with AFLAC. If you are enjoying this, be sure to click on the video on the screen now for more analysis from me. Thanks for watching, and I will catch you next time. Take care.